Hi everyone, I'm Stu. You've met Ambuja, and we're here to discuss our FIN946 report. First, the disclaimer: as we're still writing this report, what we discuss today might change significantly in the final version. So, without further ado, let's get into it. I'm going to cover Australia's approach to data minimisation and its implications for privacy and efficiency, which are ostensibly covered in the Australian privacy provisions and overseen by the Australian Information Commissioner. Data minimization principles state that you should only request information strictly necessary, hold on to it only as long as required, and never use data requested for another purpose. We know from Latitude data breach in 2023, where millions of customer records, some of which were decades old, were leaked, that this is not how most firms' data retention policies actually work. Now, while the penalties for holding excessive data can reach $2.2 million, and there are discussions to raise that to $50 million. Despite that, there have been 1,700 data breaches in the last 2.5 years, and no company has ever been fined under existing laws for breaches or holding excessive data. My view here is pretty simple. The Information Commissioner needs to stop relying on voluntary compliance remedies and start issuing fines and genuinely change the rubric on on the price for holding excessive consumer data. It needs to be a tangible cost for companies which they have to justify. Secondly, let's talk about the use of algorithms for approving or denying insurance claims and the risks of unknowingly introducing algorithmic bias into those decisions. There are significant issues with algorithmic denials based on knowable factors, as insurance payouts are life-changing amounts of money that happen at critical times in people's lives. While explainable AI might help on that front, I'm not super hopeful. Often, even the most explainable algorithms just give you that the output was changed by this endogenous variable changing. Unless, particularly when you put data soup into the start of your algorithm, it doesn't give you any clarity on what that actually means. If your data that's going in is unclear, as it often is in the case of big unstructured data, even the algorithm pointing to an input that changed is not going to give you clarity on what or why something was denied or approved. Second part of our report, the Australian company bit, we're focusing on Tiro. Tiro is an Australian early electronic cloud payments provider, and they didn't so much rely on pure regulatory arbitrage as they did by fitting themselves into a small regulatory niche. Getting a full banking license in Australia is really difficult. So Tiro instead found a niche where they could get a specialist credit card institution license, and that would allow them to provide cloud-based payment services. And they did this back in 2005. By getting this license early, they secured a first mover advantage over the major banks, who just couldn't offer similar services due to their slower tech. Tiro became a pioneer in the Australian cloud-based payments arena, and they finally secured their full Australian depository institution license back in 2015. Anyway, that's our direction for the first couple of questions. I'm going to pass over to Ambuja for the third section.
Thank you, Stuart, for the introduction. So yes, I'll be covering the third topic, which is about how two or more countries regulate a specific fintech domain. In this case, is digital ID as well as their approaches. So let's start with Europe. Europe has a very strong data protection laws as well as regulated constitution about KYC and EIDs. So European Digital ID Regulation (EUDIR) implements various regulations which allow people to port their data from one country to other. However, it does create a bit of issue when banks or other fintech providers want to innovate because they need permission to take over the data. It gets hard when you want to create something new. Let's go to the next one is India. India started India Stack from 2009 when they started Aadhaar system, and they kept building on top of it. And in 2016 2017 various issues were raised about privacy because the information was so widespread among 1.3 billion people, and everyone had access to various mechanisms through that government portal. So data privacy was implemented as a fundamental law in 2009. sorry, 2017. So it did root out some middlemen and inefficiency as well as corruption and money laundering by implementing the digital system. So it definitely had some positive ones. Now, in China, it's a different story where private companies are the ones controlling most of the data and creating their own digital profiles of people, and oftentimes sharing that information to third parties without giving proper credit to the owners as or their permission. So that created some issues which the PIPL 2021 is trying to address. However, there's no formal eKYC or digital ID from the government side as of yet. And we know in Australia there's MyGov ID, which allows you access to all your government information in one place and various other features as well. So, in conclusion, a lot of the countries are implementing digital ID, and it can be very effective to force developing countries to level up and also weed out various evils. However, and also of course allow for faster delivery of services. But it is also important to consider privacy, and since countries don't want to share all their information with all other countries, it's going to be very hard to create a system where data is shared to provide verification, but not too much information as to leak their own data or like create some privacy risk or foreign interference risk. So, thank you.